Hey everybody, morning. Looks like we got my channel members like Ivan, Rob, Will, Jerry, Don, Diane, Logan, Mark, Donald, Ed, Svenborn, Frank, Arturo, Pauline, Scott, James, Cliff, Nancy, and some channel members like Valerie, Larry, and Carlene, Kimberly, my favorite subscribers here. Now, what if I told you that economic experts had predicted tariffs were going to cause inflation and it was all completely wrong? Now, the biggest policy shift we've seen in decades has actually proven that foreign companies, not American consumers, are the ones paying the price so far. Well, today I'm going to break down one of the most shocking economic stories of 2025. The mainstream media was all over the fact that we were going to have crazy inflation caused by this tariff policy, kind of the most aggressive raises in a tariff policy we've seen since the 1930s. And instead of runaway inflation that the economists had predicted, we're seeing something completely different. Foreign exporters, especially ones with higher ticket items, are absorbing the cost, slashing the prices of their exported goods to absorb those final costs to keep prices in America basically the same. America, the United States, the largest international marketplace if you want to sell goods, as I've talked about. So the hard data from the Federal Reserve, real survey results from thousands of businesses, and we're just seeing a complete vindication of the economic argument that was dismissed as impossible. Just, just so many financial pundits argued that it was just impossible that foreign exporters would absorb the cost. Now, let me take you back. Now, we saw, Biden was trying to run for president, and Trump really, almost a year ago, was talking about how he was going to implement this tariff agenda. And, back in 2024, the people kind of skeptical on this and thought that it would be very apocalyptic. We've had a whole year of this. And so the market and the reaction to Liberation Day was all like a year in the making, kind of with this rhetoric. And the logic seemed bulletproof. If you slap a 25% tariff on Chinese goods, the American consumer is going to have to pay 25% more for those products. Simple math, right? Well, as I've shown in episodes past, that's not exactly the way it all works. See, the University of Michigan's Consumer Sentiment Survey has been showing inflation expectations sky high since April, and the highest levels we've seen since the early 1980s. We can go look at those in a few minutes. Now, the fear has been, palpable, right? But there's a contrarian voice out there, and maybe this guy, often dismissed by many people. We've seen other articles, such as Zero Hedge and Financial Times and stuff like that, also arguing that these international exporters are going to absorb the cost. And experts laughed, like, this is, I'm a financial expert and there's no way that anybody would eat the tariffs. After all, why would Chinese manufacturers voluntarily eat a 25% tariff when they could just pass it on to consumers? Well, here's what actually happened. And guess what? The contrarians were right. The experts were wrong, spectacularly wrong so far. The Bank of New York has conducted a comprehensive study in May of 2025, just last month. Businesses across the region have, that New York, New Jersey area is one of the most import-dependent areas in the country. And what they found should have been on the front page news everywhere, but guess what? About 90% of the manufacturers of foreign goods have been eating the tariffs. They've been reducing the price. They've been reducing that price so that the tariffs don't affect the final costs when they get to America. Imagine that. So the prices basically stay stable. Now here's where it gets interesting. See, manufacturers are reporting that their average tariff rate had increased by 25 percentage points, exactly what the policy intended. Service firms saw a 17 percentage point increase. If the experts were right, we should have seen a cost increase across those final prices passed directly to consumers. But that's not exactly what happened. Manufacturers reported that their costs for tariff goods increased by only 20%, 5 percentage points less than the tariff increase. Service firms saw increases only about 15%, 2 percentage points less than the tariff increases. Now think about what that means. If the tariffs went up by 25%, but the costs went up by 20%, where did the missing 5% go? It disappeared into thin air. Now, foreign suppliers have been absorbing those prices by cutting their prices. And we're seeing like Japanese manufacturers completely absorb the car increases right there. So it's interesting. Now, when you have a Chinese manufacturer selling into the American market, you face a brutal choice when tariffs hit. You can either pass on the full cost to the final consumer, but here's the problem. You're not the only game in town. There's competitors. There's Vietnam, there's Mexico, there's India, there's American manufacturers. Now, if you raise your prices by the full tariff amount, you risk losing market share to competitors. And maybe some of those competitors are willing to undercut you. It's a more complicated game than just straight up. Once you lose market share, well, it's very difficult to get it back. So what do? You eat some of the cost, you reduce your profit margins, you find efficiencies in your supply chain, you negotiate harder with your own suppliers, you do whatever it takes to keep the American consumers buying your products, because losing them is an existential threat to your continued business. The New York Fed survey found about 25% of American business was able to absorb all of the tariff-related costs without raising prices at all on final cost to consumers. These companies made strategic decisions that maintaining their customer relationships and keeping prices stable was more important than short-term costs incurred by these tariffs. Now, even among 75% of businesses that did have some cost increases, most of them only passed on a small portion of the tariff increases. Only maybe 30% of those businesses were passing on full cost of tariffs to their customers. So it really depends on which sector you're purchasing in. And this just isn't about one survey or one region. This is a fundamental misunderstanding of how global trade and competition in the global market actually works versus, a vanilla, view of tariffs and how they're going to be passed on. So the Federal Reserve Bank of San Francisco published a comprehensive survey in May of 25 also that laid out a theoretical framework. They calculated that 25% across the board tariff would be fully passed on to consumers, but really we'd only see a 2.2% increase in consumption good prices and a massive 9.5% increase in investment good prices. But this is crucial here. They included a major caveat that most media coverage ignored. See, they stated that tariffs could have a smaller effect than the estimates if foreign and domestic businesses decided to absorb some or all of the related cost increases. That's exactly what happened. The economic models assumed a perfect pass-through, but reality, competition, right? You have other choices in town. You're not the only game in town. So real-world markets are kind of messy, competitive, driven by fear, greed, complacency, and these other strategic considerations go well beyond just simply cost plus tariff costs equal final prices to consumers. So what we're witnessing is essentially a massive wealth transfer from foreign producers to American consumers and businesses. Chinese manufacturers are subsidized by their own country, and they're trying to dominate American markets. Mexican exporters are eating tariff costs to preserve their supply chain relationships. European companies are accepting lower margins to keep their American customers buying. And that's exactly what the trade policy was supposed to accomplish, making foreign producers bear some of the costs of accessing American markets rather than American consumers bearing all the cost of foreign competition. Now, there's a whole nother layer to this story. The survey data shows that businesses aren't just absorbing tariff costs, they're also restructuring the entire supply chain. A significant share of businesses report increasing their purchases from within the United States, reducing their import costs. They're building inventory buffers, diversifying their supplier base. this is kind of a supply chain resilience that policymakers have been trying to encourage for years. And it's actually happening organically just off the basis of increased tariffs. So what about inflation? Well, we're actually seeing price increases. The consumer price index actually rose 2.4% in May compared to a year earlier, up from 2.3 in April. That's barely a blip though, and it's well within the Federal Reserve's target range. But that's still prices increasing at 2.4% per year. Even more telling, the inflation we're seeing is concentrated in specific sectors and appears to be more related to other factors like wage increases, insurance cost rises. We're seeing that blow up, and maybe more than the tariffs. The New York Fed survey found that many businesses raised prices, cited that other cost pressures like wages and insurance costs raises, not really tariffs at all. And compared to these dire predictions we've had, the Yale Budget Lab estimated that maybe 2025 tariff increases would only cause consumer prices to rise by 2% in the short run, equivalent to a household losing about $3,000. But that was based on a full pass-through assumption, not actually what's happening. So they treated tariffs as if they existed in a vacuum, and if foreign producers had no choice but to pass through cost completely. But markets are competitive, and that's not exactly what's happening. So we're seeing more and more people, more and more foreign producers absorb those costs, or at least try to reduce the final pass through to the American consumer. And for decades, free trade advocates have argued that tariffs are simply taxes on consumers, but seems to be working out more like what Trump was saying. And I don't know. The conventional wisdom seems to be incomplete thought at best. And, as we've seen this actual, what we call empirical data, the real world results here, it's more complicated than any of our financial models have been suggesting. So now it's important that we're still in the early stages. This has only been going on for a couple months. The Federal Reserve researchers are careful to emphasize that their analysis only focused on the near-term direct effects, doesn't account for longer-term adjustments. Some foreign producers might decide that the American market isn't worth the reduced margins and exit, or decide that they're not going to maintain that market advantage of price and actually raise prices. Other market forces, as domestic producers and other importers raise prices, some places with higher import tariffs may be able to raise their prices too. We don't know. It's still a flexible, dynamic situation. And the survey data shows that this is kind of happening a little bit here. We're seeing businesses increasing their domestic sourcing, but also having to take into consideration the labor costs and insurance costs. So we're seeing a dynamic thing play out. We're seeing less dependence on foreign imports, and, do those foreign imports cut prices further to try to encourage more purchasing there? So it's a dynamic situation, and it's not quite been reflected accurately in mainstream financial media, I don't believe. So let me pull up and share a couple charts that I brought so we can see kind of how the Japanese car market in particular has been absorbing the costs. Give me just 1 second to flip over and pull up a chart that I can pull up and share. And right here, pull this over, share the screen right here, and pop this up a little bigger. Now, passenger car export prices, passenger car. So 2024, right there, we're seeing passenger car import prices to North America actually declining right there. It's kind of interesting. Other destinations, so the average has actually been a decline since 2024, but other destinations have actually kind of maintained right here. This is from the Bank of Japan, looking at passenger car export prices. other places, just in North America, we're seeing a large decrease right there. That's kind of interesting. It's kind of exactly what we thought might happen here. So that's Japan too. That's not just China. So Japan trying to maintain their competitive advantage, keeping prices stable for the U.S. consumer. Interesting, right? Let me know if you comments. Always, if you enjoy this kind of content and these conversations, let me know. I keep trying to come up with new topics to discuss with you and kind of explain how this stuff is actually unfolding with the real deal truth, not just mainstream media stories. We're seeing this S&P grinding higher still. It's about to complete, and we're down to 40 points away from completing the 2007 pattern. I'm starting to get nervous. I really am. So I appreciate any comments in the chat or in the comments down below. Alrighty. So looking at the S5TW, shooting back up. We may make a higher high there. S5FI might make a higher high there. S5TH still grinding in the middle. Not really big movement either way. Overnight, still seeing some choppy action. We got that pop yesterday and pushing higher today, but more, it's just grinding. We're coming up on the end of the quarter, into the half of 2025. First half over on Monday. And we'll be into earnings coming up into the second full week of July. All the financial earnings are going to start ramping up. So this should be an interesting dynamic playing out in the coming weeks here as we move on. So we're in that buyback blackout window. Buybacks expected to get announced like crazy. I mean, everything's rosy, right? Everything's good. NASDAQ all-time highs, probably set to push this on out to 23,000. Hey, everything's great. Everything's good. Until it's not. So be very, very careful. If you're long a lot of stuff, it's time to start looking for profits. If you've been sitting on the sidelines, well, we still got more sideline caution to be. I'm perma profits, right? So I warn about the risks in the market. You got to be aware and cognizant. I think that the 2007 pattern could play out in a big way. It's very possible. We have a lot of existential risks to the market right now. We have known unknowns and we have unknown unknowns. And you'll be like, well, what are the unknown unknowns? We don't know what the unknown unknowns are. We don't know what might blow out. It's like several people expected the housing market to blow out in the great financial crisis. But nobody really knew that Lehman Brothers was going to file bankruptcy, and that all these other problems and the mortgage-backed. While we knew that mortgage-backed securities were dangerous, we didn't know that that was going to be the straw that broke the camel's back. Throw one more, and then all of a sudden, so got to be careful. Pay considerably more, just paid a higher fee. Yeah, I mean, if you're buying stuff directly from China, and they're not interested in lowering their prices directly to you, you might see a substantial increase there. And I've seen some contract manufacturing stuff, like if you go to was it JLPCB or whatever, trying to get contract manufacturing of PCB boards, circuit boards, or they do CNC services and stuff like that. I've seen some crazy increases in cost, but they're not really interested in lowering their cost to absorb the tariff. So it's an interesting dynamic playing out there. But domestic, if you're trying to get a small quantity of parts made in the U.S. via CNC or PCBs, there's not a lot of that competition. That market isn't really that's not what U.S. producers are interested in competing in. So there's not much of that competition here. So those companies kind of can pass that price on in China and not really have to lower them for cost competitive reasons. So when you're just buying a small quantity, but bigger quantity, we're seeing prices get absorbed in somewhat. So an update on my FedEx situation. I called FedEx like 5 times. 4 times I think the AI hung up on me. By the 4th time I figured out, or I caught the clue on the 4th time that if I entered my tracking number, it was going to go into this loop and tell me that everything was good and hang up on me. Just great system right there. So on the 5th time, I called in and said I wanted to file a claim, and it was asking me if I had a tracking number, and I just was like, I want to speak to somebody, and I was very insistent, and it dropped me into this menu and threw me out to a representative. I was like, hey, this package keeps bouncing back and forth between these 2 cities, and they were like, let me take a look. What's the number? And they looked it up, and they were like, oh, we'll get this fixed for you, and it's out for delivery in Knoxville today. It went from Kansas overnight. It went from Kansas to Nashville to Knoxville, out to delivery this morning, and I'll see if it gets delivered here in a little bit. It's kind of funny that it's knocked. FedEx, yeah, FDX right there. Down this morning, I guess the effects of my package getting delivered, putting downward pressure there. So that was on the biggest losers list there, reporting earnings yesterday. Not impressing. They actually removed their forward guidance, so not super bullish on FedEx. That looks like a first move down potential right there, and we might get that copy pasted over here. So we may see prices come on down to 208 before we find a bottom, if FedEx is going to go on higher here. Right there. Already working on the bottom there. So that one's interesting. Rocket Lab continuing up. I may step off of this one at 36. Just not like, this has been a crazy move right here. Probably do a big pullback right there. Then let's see. This one just kind of, like, look how much this has been moving, and we're just sitting here. Like, this is the tightest little consolidation. We had one of those over here on the way down. So maybe we're doing another little tight consolidation. We'd get a little pop and then another drop. I don't know. We'll see what happens on this one. Nike reporting earnings tomorrow after the close. That looks bullish, but we could get a pullback in the 57 area here. We're seeing Merck. Looks like we're doing a wave 4 consolidation here. We might see a wave 5. Could pop to the roadmap line, or could just pop back to that resistance from that prior high. This is still a downtrend, but we've been sitting on support for 2 months now without really making any further progress, much lower. So is it one of these and then we drop further, or is it a actual bottom that we can build a reversal off of? I'm betting on the bottom we can build a reversal off of, but not looking for a huge upside here. We'll see what happens. See what happens on that one. And let's see. Trying to remember the other, like, trying to remember all the companies reporting earnings. So Nike coming up. MU, that one's another one everybody seems to be concerned about, but I don't think earnings is going to matter. Like, look, green, and it's just kind of doing its own thing. Now, it could get a reaction. We could pull back to the roadmap line, but we could also pop out to the target. One big pop. We've got the setup to do it. We're into this resistance here, though, so we might get a pullback. That's entirely possible. So there's the kind of outline there. We might pop the target. Has a bigger setup to go even higher. This one reports after the close today. I'm not particularly concerned either way, but with the AI ramp, MU in big demand. So does that translate to bigger profits and bigger projections, or are they going to disappoint? I don't know. I don't believe that earnings moves the charts, so I'm in a bullish bet, looking for that bigger pop. It's kind of the way I'm set up right now. CL, so far, holding. Oop. I just made a trade. So far, holding right there. If we can hold it and bounce back higher through that, the upside looks like we're going to 90 to 100 area right up in here. On oil, if you haven't bought anything, you could buy some long exposure. That could last well out into the fall right there. GC, probably continuing the downward slog here. Probably going on this correction that I've been talking about. All indications, if we break down below this support around 3,300, probably coming on down. Probably get continuation lower. Bitcoin might have that bottom in place. That was 3 down. We might be set up to blast on out in the final run here. This would be interesting if we do a final run up into the target area here in the next couple weeks, and the S&P takes its run to complete the 2007 pattern. We might wrap everything up early and go into a big downward go into the last half of the year or the later quarter of the year. Concerning. Ethereum not really showing any bullishness. NKD attempting the push out here. Still have resistance at the top of the box. See what happens there. 1 day does not make a new trend for me. Dollar, as I've talked about ad nauseum, this potentially going to push down further into the target zone here. We've got these tails down here. Came up shy of the target. And we may see this push a little lower. Now, we could hold the higher low, the resistance, all the way up here at 102. So Mag 7 stuff, Apple still sitting in the consolidation. Amazon still sitting in the consolidation. Hadn't really gone anywhere since May. It's a whole month of sideways, month and a half. Google, not really gone anywhere since late May. It's a month of just churning in this 170 area. Meta, grinding up just a little bit. As long as we're lower than this high over here, still has a possibility. Even if we do poke a higher high, we could still get the second move down. That's poking higher high doesn't negate that corrective type price action. So even though that one looks more bullish, it still can be a corrective type price action there. Microsoft hitting targets, extension on up at 508. Seems to be heading that way. Nvidia pushing up higher, getting close to the all-time high. That one also may push higher. 164 was the target up there. It's been there for a couple months. Still has the potential to go down again very violently. Be careful. Tesla right here. It looks like potentially that was it for that rally. We may see this push down back into the 270 area here. We'll see. I have a 330 call sold against my shares for this Friday. $7 in the money. We'll see where we end up on Friday. Now I go pull gainers and decliners. Coinbase breaking out. Fresh high here. 396. Gonna go for the all-time high, maybe. Up there around 425-ish. The immediate upside resistance, 396, possibly 442, with that all-time high sitting at 425, 423, 425 area right there. And if we get super sparky, we could see something up to 600 here on Coinbase. AVAV, sitting right there, all-time high. Has the potential, big measured bounce, 492, 500 area up here. WOR, I have 9 tickers that are set up for an entry today, so stick around to the end. Cover some of that. This one looks like the upside resistance, 76, maybe 82 targets there. FUTU, coming up pretty strong here, 142 potential. Reddit, up into that resistance right there. If we can step across it, we might go on up to a new high, 269. If we turn down off of it, we could be like the Mag 7s and take a trip down. Be careful. App loving. Turn down here. If we break back below the roadmap line, we could go on a deeper swing there, similar to Mag 7s. LNW, Light and Wonder, 3-wave retrace. If we pop back up through the 618 here, set up the 122 upside target. MSTR, be careful. Still sitting in this consolidation we've been in since back here in late May. Haven't been able to push up or down. Support down here at the roadmap line, 325. If we can bust back through the resistance up here at 430, that would set us up for potentially a go at 600 or higher on the target zone there. PTIR is leveraged PLTR. Sezzle probably rallying on up to 330 area. Hooks is Robinhood. Connell is Coinbase. ULY urgently. That looks like a dumpster fire in the making there. No uptrend at all. Lemon, Natus. Let's see. That high, that low. Coming up into targets here. 334 might be the upside there. Be careful. We might see a pullback. CoreWeave grinding that high at 182. Bulls might be setting up for an extension, but this is now the S&P and NASDAQ are hanging out up here at highs. NASDAQ pushing new highs. This one hanging out down here, significantly lower. So be careful. We got to, it may underperform on any kind of upside here. Another 2x long on Hood. Hooks is another one. Robinhood pushing on out. Getting to the all-time high right there. Can we push on through? 109 might be the next upside target there. And be careful. We might see a negative reaction before we push on out right there. RGC keeps being a little crazy. That may have been the blow off. We might see this come on back down to back to reality. This has reverse splits. Danger, danger, danger. A coin, round hill coin weekly pay. So this is going to be some sort of covered call strategy, similar to Connie right there. Pull up the Coinbase, and Connie is not a good proxy for Coinbase. Connell, maybe not a great one either, but CYW, kind of an interesting. Has a weekly dividend. It's kind of interesting. I'm not seeing a weekly dividend. Right there. It's an interesting one, Goose, right there. CLS, never know what you're going to find on the morning list. That's why I do it. CLS 164 upside target. CRDO 97 upside target. IONX is IONQs. Reddit is RDTLs. 2x leverage on Reddit. Yum. Might have a bottom in place. Slightly lower low. We can break up through that 618. Looking for 166 on the upside there. 5. Still hunting a bottom. Not convinced. We may see this rally back up to a 618 resistance. Right in this vicinity, around 200, and then turn down again. LEU. Chopping here at just below that 215 target. Oklo. If we can hold this breakout level, which we have been so far, we can maintain it. Upside target immediately, 82. And if we keep the upside pressure, 125. But be careful, the higher we push, the more likely a bigger correction like this one is that we're going to do. Not messing with that. SPAC. PSIX. Probably going on up to 78. Decliners. FedEx. As I already mentioned, probably look out in that bottom right there. ASTS. Was a decliner. Turning around here a little bit. 61.58 upside. PayX. Ooh. Look at that. That's why I warned about that. Like, look at that. Hit that 1618 right there. And violent retrace. It's like, why that one? Well, it's just been on the chart for a while. But when we line this up over here, lines up with a 1448 right there. Very sloppy on my, I don't have my price put exactly on there properly. And tag that 1448, which just happened to line up with the 1618 of that. And violent retrace. Support right in here at 135. And if we get below that, we may see a bigger, deeper retrace for PayX. FBRX. Bioscience. Skip. Pass. General Mills. Getting destroyed. Golly, man. This is down to a 618. Right there. I'm looking for this to hold in this 44 to 50 area right here. If we can hold it, break back through the roadmap line, this sets up a giant upside potential. Let's just say we hold right where we are. Talking about giant upside. Something back up to 100, 150. 3x potential over the next couple years. Could be pretty strong. CDTX. Syndra Therapeutics. Nothing. South Korea taking a little bit of pullback. This has been an absolute monster. Due for a pullback. Even though it's a 3x bull, it might be bigger than normal. Carmar Therapeutics. Another biotech pharma. PALL. And Palladium is not really ripping. PP. Platinum's the one that seems to be ripping. This is probably heading on up to this target. Palladium has the potential to break out and ride along, but right now it's not proving it's doing it. We're looking at the resistance provided by that prior high on PPLT. If we can break through, nice upside potential there. Stuff that was set up for an entry today. This one already had a potential. What's this, today's list? Let's see. Let me refresh this really quickly. Make sure this was today's list. Yeah. That one has a potential 150 right there. Oh, I reviewed that last night on 30 Minutes of Awesome. That's why I already had that drawn. CCBG. This looks much more bullish than APO. Close right there. 40 target right there. Didn't pick up on this system. CIX. That one did pick up right there. This high, this low. Entry right there. Target 27 79 IEF. 7 to 10 year treasury bond. This one was already in back here on this big swing. Now we've got this smaller swing, and it's in here with a target right up around 96. 96.50 right there. Been doing this long enough I can kind of see where the fib lines are going to be. In you, there's another one. There's the high, there's the low. Breaking out, 14 target right there, PAGS. Here's the high, here's the low. 1040 upside target. SBAC. Here's the high, here's the low. That one didn't actually touch the roadmap line on this chart. It's going to be a difference in the roadmap line calculation between financial data and scientific data. Let's pass on that one. TSBK. I would have picked up this small swing right there. 37.72 target. BIA. I'm probably not taking any of these. They don't look particularly spicy to me. And the smaller swing right there, that was the 1142 target. So, not new scale, one that looks pretty good, and that's not even a big upside target there. And then it's part of the bigger pullback back here. Getting above that, we could set that up for a bigger move to 17 right there on new scale, or new holdings. Is that the right new? Yeah, new holding. I guess change their all right. Bias for the day. Let's see. Checking the comments here. Best way to personalize and video in queue. Trying to complete potential topping pattern. Yep. Let's see. Network news last night. TM increased the price by 200. $200 is not much though on a car. That's probably more to do with labor costs than it is. Anyway, all right, bias for the day. S&P. Looks like we might pop out. I mean, that's entirely possible here. That next upside target from the last pullback sitting right there, just under the all-time high. And since we've come all this way, why not just poke out? Resistance at, I'm going to say 61.50. If we can get through it, we could see 63.60. But I'm thinking we get some sort of pullback before we do that if we're going to go ramping on up. And if we do complete this in the next couple of weeks, watch out for the 2007 pattern completing right here. That would be a completion of this pattern. And we did push it on up for a couple more weeks here, a couple more candles. The weekly candles is what looks like this. Not good. Not good, not good. So when we look at the weekly pattern here, if we push that on out a few more weeks, possibly spike that up there. A few more weekly candles up here. Could set up that 50 to 60% retrace on the S&P. Be careful out there. You can't just say maybe your own. Have a great day, everybody. I'll be in Discord, hanging out, answering questions as I get them. And we'll see you tomorrow. Same bat time, same bat channel. Do it all over again. Hunt for opportunities.